silver goes up in another leg here, another extension of this repricing new reality, these other metals aren't going to be sitting there at fourfold. They'll probably be at sixfold, sevenfold versus 1980. So silver's not going to go to 200 fourfold. It's probably going to go much higher. And I don't want to pin a number on it. It wouldn't shock me, don't chuckle, if you had $1,000 mark on silver at some point in the next year, okay? Because there's a lot of things going on out there. We can get into that. Where's gold right now? Well, the bear low is 1,050 in 2015. We're fourfold. So if gold even just said, oh, I'm going to do it again, have yet another eightfold dimension move, then you're talking $8,000 to $9,000 gold just to match the dimensionality of those two prior moves.
Silver may be entering a phase where an ordinary rally turns into a much larger repricing. The long-term momentum structure remains positive, while the recent recovery suggests the market may be preparing for another powerful leg higher. Michael Oliver, a market technician focused on momentum and structural analysis, emphasizes that silver has lagged far behind both gold and major base metals. He argues that this pricing gap could eventually close with unusual speed, especially because silver has spent years trading well below the relative levels implied by other metals. His outlook is aggressive. He believes silver could work back toward and through its previous highs in roughly a month, then accelerate as investors begin recognizing deeper monetary and debt problems. He says a move toward $150 could arrive before the financial headlines fully explain it, and he would not be shocked to see silver approach $1,000 sometime within the next year. Gold could also reach roughly $8,000 to $9,000 if it repeats the scale of earlier bull market advances, as this repricing gathers momentum. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I'm going to lift my target, and I don't mean lower it. I mean probably lift it, and I'm not going to put a number on it. I'm just going to say that I think silver will go berserk. And the reasons are, there's multiple reasons. We can get into those. But yes, and the action last week turned up our intermediate trend metrics, momentum things. Now, what I mean by that is when you look at long-term analysis of silver and gold bull trends, like annual momentum, so forth, the break was a nice break, but it didn't break anything. It didn't break any structures on momentum. So the long-term trend remains positive. That was a negative zigzag and a positive trend. So, but when we go down to more intermediate technical factors, things that come and go in a matter of a couple months or several months, they turn negative. They turned negative about in March, really, prior to that war break. Okay. But since then, if you stand back and look at a silver or gold chart, go back to that break that occurred in late January, early February. It was really about a 2-day break. People don't realize it was like 2 days. Bam. Silver hit a low of 63.90. Whew. And then went back up to like $90 and then came down and made another low at about 61. Didn't fall apart and turned back up again. Teasing rally. Then came back down again, got to about 56. Okay. But right now we're trading 65. Okay. We're back above those lows, all the lows that occurred, the sequence of lows. But if you think about it, all those lows were like marginal teasers. The real low occurred 2 days after the high in February. And so since then, you could draw a line sideways on silver and say, well, yeah, it's still under pressure, but it really isn't going down much since 6 months ago. Okay. So somebody's been buying that beast down there. Okay. Same with gold, same sort of pattern of a low in early February, then another low in March, and then you get the point. The upturn we just had last week on most people's charts say, well, it's just another rally in this nonsense range. It's no good. It's just a sell the rally. But when you look at momentum, it says, no, this one's different. This is a rally that will likely sustain and work its way back to and through the highs. And I don't think it's going to take a long time. I think it may take like a month. Suddenly you're back up well off the lows and challenging high. But forget that. The issue is, where are we going? And a lot of people make the mistake of taking out their old daily price charts or weekly charts from 1980 or that second high we made at $50 in silver in 2011. And they say, well, we just collapsed just like that 1980 peak, and it took them decades to get back up again. Okay. Well, that's assuming, don't look at the old arithmetic charts. Look at a ratio scale chart, percent scale. We've run these charts before, but think about this just for a moment. You don't have to be a technician. Metals. Let's see what metals here. These are just examples. Lead, steel, zinc, aluminum, copper, all base metals, and gold. Where are they trading right now versus where they made their highs back in 1980? About 4 times that price level. Okay, 4 times. Gold's more than 4 times where its bear low was in 2015 or where it was in 1980 when it made a peak at 850. Multiply that times 4 and you're above that level. Silver's what? Trading 10, 15 cents above its 1980 high. So let's say silver made a mistake, supply-demand mistake. We know we have a deficit. It's been for 6 years or so where we're not producing enough silver to match the demand. And yet that's ignored. The fact that most metals on the planet are 4 times where they were in 1980. And yet silver is overdone, with a pullback recently to a 6 cents above its 1980 high. I mean, give me a break. Okay, so what caused that? Well, I don't have the answer. Some people I respect do, and they argue it's been actually manipulated by major banks, perhaps working in shoulder to shoulder with the central bank. I don't know. Forget that issue. But obviously, silver, for some reason, has not moved in reality with every metal on the planet. And its mama metal in the monetary sector, gold. It moves with gold, right? Okay. Well, how come when silver back in 1980, for example, was what? 6.5% of the price of gold. Divide an ounce of silver and an ounce of gold. Where's silver right now? About 1.5%. What's going on here? We don't need silver anymore? It's not money anymore? No. Silver made a mistake. And therefore, to get back to the first issue about where we're going, even if it went up 4-fold, which would put it, $200 silver above the $50 high, that would be normal. But most markets don't move when they make a big mistake for a protracted period of time, like way too high for too long or way too low for too long. When they compensate for the mistake, they often do 2 things. 1, they compensate with speed that sometimes is shocking, and 2, an overshoot of reality. Okay. And of course, if silver goes up in another leg here, another extension of this repricing new reality, these other metals aren't going to be sitting there at 4-fold. They'll probably be at 6-fold, 7-fold versus 1980. So silver's not going to go to 200 4-fold. It's probably going to go much higher. And I don't want to pin a number on it. It wouldn't shock me. Don't chuckle. If you had $1,000 mark on silver at some point in the next year, okay? Because there's a lot of things going on out there. We can get into that.
Silver's recent weakness may look like another failed rally on a price chart, but the momentum picture points in a different direction. The trend never broke, and the latest upturn suggests the intermediate structure has shifted back toward strength. The deeper case rests on relative pricing. Many metals now trade several times above their 1980 levels, while silver has barely moved beyond its old peak. That imbalance, combined with years of supply deficits, creates the possibility of a sharp catch-up move. Markets that stay mispriced for too long often correct quickly and can overshoot fair value. The projection is that silver could move through the current congestion, challenge prior highs within about a month, and then accelerate dramatically. A move toward $150 may arrive before the broader monetary crisis becomes a dominant headline, with even higher levels possible if the repricing becomes extreme. Now, let's get back to the interview.
Now it's an issue about where's gold going, the mama. Okay, I've said this before, but you go back to the history of gold since it was, quote, legalized in the U.S. There was a bear low in 76 that went up to a high in 1980, and it was an 8-fold move. Price of the bear low to the bull high, 8 times. Okay, different duration bull market, but from 2001 to 2011, gold had another 8-fold move from a bear low to a bull high. Where's gold right now? Well, the bear low was 1,050 in 2015. We're 4-fold. So if gold even just said, oh, I'm going to do it again, have yet another 8-fold dimension move, then you're talking $8,000 to $9,000 gold just to match the dimensionality of those two prior moves. What if gold goes further, which I think it likely will, because I think we're facing something we've never faced before. I mean, gold's gone up due to monetary expansion, inflation, et cetera, et cetera. Inflation is defined by money growth, okay? This time we have a monster, a nuclear event with the government debt market, because when they have to print to keep that house from burning down, it'll go off the page. And people will then say, well, goodness gracious, I thought, it was 60% stocks, 40% bonds, was a balanced portfolio. Oh, that's right. The CIO of Morgan Stanley about 6 months ago said, no, it's 60% 20-20 bonds, gold. He brought gold into the equation. I don't agree with his percentages, but his recognition of the reality was very bold. Gold must be in your portfolio. But what if bonds don't work? What if the stock market's topping, as we argue it is, and it won't take much to really get it going on the downside, like, a 10% drop will cinch that it's topped. I think that will occur. That will further motivate the Fed into printing. But then when you say, well, I'm going to go to the alternative that usually is a safe place to be, it isn't T-bonds. They're horrible looking. Look at the price chart. Look at the yield charts. And they've just begun. We're entering what probably is going to be a bond market panic. And of course, we know what the Fed's going to do during that time. There'll be no limit to what they do. And that leaves you with what alternative? Money, gold. It's somebody looking for an excuse to why silver didn't go up like gold. Okay. And so they say, whoa, China is buying gold, not silver. Okay. Well, I think India is actually heavily involved in silver right now and even moving toward monetizing it maybe. But for 3,000 years, silver's been money, poor man's gold. Okay. With official government stamps on it even. Okay. So no, I don't think suddenly now, because somebody wants to explain why silver didn't match gold, it's not money anymore. We suddenly decided. Well, we'll see. Okay, I don't accept that argument. I think what's going to happen is silver's just simply made an error. A lot of markets do, and whether that was in part manipulation, but it's when it unleashes, it goes to a new reality. It likely will overshoot that reality even. But I'm looking at various metrics, not merely that if all these metals are 4 times their price in 1980, well, they're not stopping either. Copper's continued 6 times where it was in 1980 right now, okay? 1980 was $1. Okay. The point is that silver, if it's compensating for that major error, pricing error, relative to anything, relative to all these basket of base metals, gold, et cetera, it likely will do it with speed. And I suspect that when that event occurs, and I think it's coming, I think when we come up out of this congestion, and already we have signals that we're coming up out of here. Okay, you can wait till the new high if you want to. But on the other side of this congestion zone will be something that will drop jaws, and be so rapid, so quick that people just won't understand it. But at that point in time, I'm going to bet that certain other fundamental factors come into play that already are in play, but have been long ignored by investors and analysts and talking heads on financial TV, mainly monetary crisis, debt crisis, government debt crisis. We haven't had one of those in a long, long time. Okay. In 2008, the markets collapsed. Silver and gold went up, 2000 through 2011. But the stock market went down because of what? A debt crisis, but it was just mortgages. This time it's government bonds. This is a nuclear event. And it's only now marginally becoming sort of a sideline issue on financial press. It's so major it should be the front headline and should have been for a year now. The Japanese went into the hole, and now suddenly we're going into the hole with them. In fact, we're helping fund them try to get out of the hole. We're printing money to support the yen, so they'll continue to hold bonds, like a circle there. Okay, it's a game. But it involves what? Printing money. That's what moves monetary metals. But that other side of that move in silver, when it occurs, I suspect you're going to start to hear the fundamentals that really matter. And I don't just mean the increasing demand industrial for silver, but I'm talking about the monetary crisis. And those headlines will suddenly come up to the fore, but silver will then be 150, 200, 250. And all of a sudden people say, oh, now I understand. Okay, that's usually the way it occurs. It rarely is that all the real truth headlines come before the move occurs. It doesn't happen that way. It usually comes later, and I suspect that's when silver will look like a wet bar of soap. We already are in the crisis, really. What we're going to hear later is the wave effects of the crisis. For example, at MSA, we're not just watching things like AI and semiconductors, although it did give a good call on the semiconductors at the top. We're not far off the top. We said, that's it. Okay. The real issue is this underlying multi-decade government debt crisis and the jeopardy of the fiat currencies, not just Japanese yen, but us, Europe. We're all in the same soup. And it's just a matter of degree and when. Japanese first, us second, Europe's going to be next. But fiat currencies in a crisis like this will come into severe doubt. People say, well, this has been kind of neat for the last multiple decades, 100 years or so, but it ain't working. It's not backed by anything, and it's out of control, and all we keep doing is printing more of it. And, I probably said it on your show before that, when your granddad built a house, it was $4,500. When your dad built one, it was $45,000. Now a median home is $450,000. What does that reflect? Okay, degradation in the money unit. Okay, the stock market right now, S&P, for example, you go back to the year 2000, the dot-com high, look at the multiple gain in the S&P, where it is now versus then, and then go back and look at an M2 chart and see where M2 money supply was in 2000 versus now. Oh, S&P has matched the decay in the money unit. That's all it's done. The S&P, I can't buy more loaves of bread now than I could back in 2000 with the S&P. Gold has massively beat that, stayed ahead of it. It's held its value. Silver's lagging, and that's where we get the slingshot. But anyway, it's going to be very interesting because there are many fundamentals out there that are all interconnected with this debt problem and the fiat currencies that will suddenly pop into play. We're watching financial sector. I mentioned the AI, which everybody's watching, and semis is the most watched thing. But you got to watch the financials in the key banks and also the commercial real estate market. ETFs like RWR, VNQ. There's something wrong there. And the Fed can't allow any headline story to come out of a large bank. No, we're not going to go under because they'll print the money. But you can't have a major debt story about, major credit problem here. Another one. Oh, another one. Suddenly, the entire view of the investor public will shift, and they'll realize, they'll be ambushed, in other words, by a reality that's already been there.
The bigger story is not simply a metals rally. The argument is that government debt, weakening fiat currencies, stressed banks, and commercial real estate could combine into a monetary event powerful enough to change how investors think about safety, inflation, and portfolio protection. The concern centers on the bond market. If government bonds enter a deeper panic and stocks confirm a major top, policymakers may respond with much more aggressive money creation. That would strengthen the case for monetary metals because the traditional refuge of bonds could look far less secure. Gold has already preserved purchasing power better than broad equities when viewed against long-term monetary expansion, while silver remains the laggard with greater catch-up potential. From that setup comes the most dramatic forecast. Gold could eventually reach around $8,000 to $9,000 simply by matching the scale of earlier eightfold bull market moves, with further upside possible if the debt crisis becomes more severe. Silver could react even faster, potentially surging toward $150 as the crisis becomes obvious, and, in an extreme repricing, approaching $1,000 within a year. The warning is that markets may move before the headlines explain why. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.